Hey everyone, welcome back to our channel. If you're passionate about investing, or if you're just curious about the world of finance, you've come to the right place. Today, we're diving into an essential concept that every investor should understand, the ETF expense ratio. So, grab your favorite beverage, get comfortable, and let's get started. Now, you might be wondering, what exactly is an ETF expense ratio, and why should you care? Great question. Let's break it down. First things first, ETF stands for Exchange Traded Fund. It's a type of investment fund that is traded on stock exchanges, much like individual stocks. ETFs are popular because they offer a way to invest in a diversified portfolio of assets, like stocks, bonds, or commodities, without needing to buy each asset individually. Now, the expense ratio is a critical factor to consider when investing in ETFs. So, what is it? The expense ratio is a measure of what it costs to operate the ETF on an annual basis. This includes management fees, administrative fees, and any other costs associated with managing the fund. It is expressed as a percentage of the fund's average assets under management. For example, if an ETF has an expense ratio of 0.5%, that means you're paying 50 cents for every $100 you invest in that ETF. Seems small, right? But let's put it into perspective. Imagine you invest $10,000 in ETF with a 0.5% expense ratio. Over the course of a year, you'd pay $50 in fees. Now, if you were to invest in a different ETF with an expense ratio of 1%, you'd pay $100 in fees for the same $10,000 investment. While the difference might seem minor, over time, it can significantly impact your returns. A study from Morningstar showed that lower expense ratios tend to correlate with higher net returns for investors over time. To illustrate this, let's look at an example. If you invest $10,000 in an ETF with a 0.5% expense ratio and it grows at an average annual rate of 7% for 30 years, you'd end up with approximately $76,123. However, if you invested in an ETF with a 1% expense ratio and experienced the same growth rate, you'd end up with around $57,308. That's a difference of nearly $19,000 simply due to the expense ratio. So, how can you find the expense ratio of an ETF you're interested in? Most financial websites, brokerage platforms, and the ETF provider's website will list the expense ratio right in the fund's details. It's also worth noting that not all expense ratios are created equal. Some ETFs, especially actively managed ones, may have higher expense ratios because they require more management and research. On the other hand, passively managed ETFs, which track an index, generally have lower expense ratios since they don't require as much oversight. When evaluating an ETF, it's essential to consider the expense ratio in conjunction with the fund's investment strategy, historical performance, and how it fits into your overall investment portfolio. Another important aspect to consider is the impact of expense ratios on your investment returns. High fees can eat into your profits, especially during market downturns when every dollar counts. Therefore, choosing ETFs with lower expense ratios can be a smart strategy to maximize your investment returns over time. Let's take a look at how an ETF's expense ratio can influence your investment strategy. If you're a long-term investor, even a seemingly small difference in expense ratios can compound over the years, leading to substantial differences in your overall portfolio value. Additionally, if you're someone who frequently trades ETFs, it's essential to keep an eye on the expense ratios as well. High expense ratios can make it less cost-effective to trade frequently, so finding a balance between trading frequency and expense ratios is vital. In summary, the ETF expense ratio is a crucial factor that can significantly impact your investment returns over time. Understanding and comparing expense ratios is essential for making informed investment decisions. Remember, a lower expense ratio doesn't always mean a better investment, so consider the overall strategy, performance, and how it fits into your financial goals. If you found this video helpful, don't forget to hit that like button and subscribe for more educational content. Also, leave us a comment below with any questions or topics you'd like us to cover next. Thanks for watching. and happy investing. See you in the next video.